bottom line, are you concerned about another financial crisis now?
Absolutely. We're on the we've been on the ledge of financial crisis. I would say since SVB, since the crypto, we are at a point where capital search for yield has reached kind of the beyond the point of it being profitable. It is now just it's turned in on itself.
Our next guest is Mehrsa Baradaran. She is a professor of law at UC Irvine, and she's an expert on banking regulation, banking law, financial regulations in general, and her area of research, income and wealth inequality. Very interesting topics. We'll be talking about all these things with her. Welcome to the show.
Thank you so much for having me, David.
Professor Baradaran, you were very intimately involved with the formation of Dodd-Frank. You told me offline, and you are very well familiar with the regulations that have evolved over the last 15 years. So I'll start by asking you how banking regulations have evolved. First, we'll start there. We'll talk about what's next for the future.
Yeah. Well, my involvement was that I was at Davis Polk in the banking group while, the financial crisis was going down. And, I would say that my eyes were just open in the way that the how legislation gets made, how our clients, which were the banks, were very intimately involved in the making of that legislation because we were representing them, and that the complexity of the law is currently used as a way of kind of maintaining that close proximity of regulator and regulated. And in a way, if there was one lesson from the financial crisis, it was, one of the lessons from the soft regulation is that there was like a real close tie with, the regulator of Goldman Sachs, let's say, that was just sitting in a floor at a bank. And it was very difficult to have those relationships. And what I saw in Dodd-Frank was a continuation of that system, although albeit, yes, like there's more regulation, more law, a lot more. It's like 2,000 pages of regulation more, but that complexity kind of shrouded the reforms from the sort of public scrutiny that I think that they needed. And since then, it's only gotten more complex, and it really is a very inside game. And that I think is not the best way for a democracy to regulate its banks.
Do you think banks have overall become safer as institutions? By safer, I mean better capitalized, better controlled, better regulated, less likely to fail following the advent of Dodd-Frank?
I think that banks cannot fail after Dodd-Frank because the backstops that were created during the financial crisis were so successful. And I mean the bailouts, the all of the programs that the Fed put together were so successful at just ending the crisis that it was clear afterwards that even if we came to the brink again, and we did with the SVB Bank, we did during COVID, there was a Treasury freeze during COVID, and the Fed over a weekend redid the entire 2008 bailout over a weekend, with the same amount of force after having innovated it. SVB, same thing. So I think the Fed just got better at spotting the issues and then coming in with just guns blazing. So I don't know if that's the right question, in that, like, we're not really regulating banks better. No, I don't think so. We don't have a presidentially appointed regulator at any of the banking agencies right now. And I know that intimately. I was on the transition and what was one of the nominees. So no, we're not regulating, but I think they are safer insofar as the dollar withstands the international pressure that it's under. So it is very much true, as Ken Lewis said during the financial crisis, that the banks and the government are very much tied together at this point, and more so than before.
One question I commonly see is, if a sufficient number of banks fail, could the FDIC go under? In other words, does the FDIC have enough in their reserves to even support or backstop all the deposits available?
So the FDIC went into the red during 2008, and the FDIC, however, is connected to the Treasury, and the Treasury is connected to the Federal Reserve. And that's the thing that I've been pointing out as a scholar since all of my books, is that at the end of the day, it is the federal government, the money printer, the money creator, that is underscoring, that is subsidizing our bank's failure. And we have tried through policy, Glass-Steagall Act, FDIC laws back in the 30s to make it more insurance-like. So you have to pay premiums and risk premiums and all of that. But what we know is that during a crisis, anytime there's a threat of overshooting, the Fed is going to come in with money. Now, we don't call it like, it's not taxpayer money. You don't have to take it from somewhere and put it somewhere else. That's not the way money works. They can just infuse the banks with liquidity. That's what it's called. So no, it's impossible for the FDIC to run out of money. Is it possible for the dollar to lose trust? Because that's the currency of banking, is trust. And that's also what underscores the money system. Money is an intangible idea, and it's paper here. It's not backed by anything.
What do you mean
it's just
lose trust? Like in terms of
so a bank run is a psychological phenomenon,
sure,
right?
yeah.
People go in and they take out their money, and then what the government comes in and says is, your money's safe. We've got all the money here. Don't worry about it, right? It's like the George Bailey, like, if you keep your money in the bank, it's going to be fine. But if everyone takes it out, it's not fine. And it's not the exact same with monetary policy, but kind of, in that right now, the dollar is the world's currency. And insofar as that remains, our banks are going to be okay. But politics and economics being tied in together as they are, when the debt crisis, back, I don't know if your college remember, there was in the 2010s when Ted Cruz tried to bring us to the point of default, there was a lot of conversation on a real threat that maybe other nations wouldn't trust the dollar if we defaulted, which is true. The Treasury has never defaulted on a payment. Could that happen if our politics get sufficiently insane? And this is why it's not separate. What's happening in finance isn't separate from what's happening in politics. It's hard to see now because it's worked. But look around, and you can see that a lot of those things are dysfunctional.
Here's a more philosophical discussion. Why regulate banks in the first place? Why not just let them fail if they're on the verge of failure? And as consumers or depositors, we have the option of choosing, if we have the knowledge to, the safest, most prudent banks out there.
I think this is the most important question about banks. And when you understand banks and banking, you get down to this question and this is Brandeis, or Louis Brandeis said, banks profit from the use of other people's money. It's not, if you can let Walmart fail, but when you let a bank fail, that's my money, right? So banks work on fractional reserve lending. They take and then they lend. And then if there isn't a backstop, that's our money being lost. And that's maybe not a problem. Look, these are big investors, they're fine, but it's the panic, right? So the Great Depression isn't just, oh, one bank fails. It's that when that bank fails and everyone thinks, oh, my bank is next, it will be next. So it's a psychological phenomenon. Same thing with the financial crisis. The financial crisis was a panicked exit from the market. It was a run essentially on investment banks that were supposedly not runnable because they weren't using deposits. But there was so much interconnectedness that when Bear fails, when Lehman fails, Merrill Lynch was next. And that's why over a weekend, they had to force the marriage of Bank of America and Merrill Lynch, is because you can't have the next domino and then it's just a free fall after that.
Suppose those banks were allowed to fail. Suppose the government didn't come in to backstop these banks. How would the financial crisis have unfolded differently, you think?
So in my new book, The Quiet Coup, I go back into that moment because I think that's the moment where neoliberalism, which is the topic of the book, this idea that that we have a free market and that the less regulation, the better it is for the market and banks and profits. All of that ideology on which the Wall Street risk machine was built crumbled in an instant. The idea was that banks have a better handle on their risks than any regulator could, that they know what they're doing, that these are sophisticated, rational individuals. And it was like, no, it was psychology all along. It was animal spirits, whatever Keynes called it. And at that moment, there was a chance to just kind of reset. That's what FDR did during the Great Depression, to say, look, you've got, just recreate the system in the way that we understand it, which is that at the end of the day, the public fisc is underwriting these banks. Even when you tried for decades to not even be a bank, these investment banks were not regulated as banks. They are now because of the financial crisis. But for many, many decades, they said, we're not runnable, we're different, we're doing these investments, whatever. So the right way to deal with that is to just call a thing and say, okay, you're a bank and now you're regulated like a bank, but also that to recognize that the entire system is supported by the government. And if that is true, and if the next bailout comes, we will be supporting it. What kind of system would benefit all of us? what kind of system do we want? Do we want that much risk being run up? Do we want, private equity to be making these financial decisions on housing and things like that? And instead of putting that to a vote, what our policymakers did, the Hope and Change president and his group just brought the banks back to profitability and then tried to convince us that they were now not going to be, no more bailouts. That was like the promise, is this is never going to happen again. And that was a lie. And I think a lot of people, it wasn't a lie. It was just,
This is the debate that a lot of people
yeah,
are having, right? It's yeah, exactly. How many how far should governments go to bail out these banks? On the one hand, if we announce no more bailouts ever, that's going to lose, I guess, some confidence in the banking sector. But on the other hand, if we promise to bail them out, that's going to incentivize reckless behavior. I guess that's where the regulations come in, right? So there's a
I'm saying
fine line here.
The question isn't a fair. It's not right, because the banks exist and work only insofar as there's FDIC insurance and federal government funds. I mean, this is Walter Bagehot. You go back to the 1700s in the Bank of England. Every banking theorist, and this is not philosophical, this is actually markets, is Walter Bagehot says, like, the way to have a safe banking industry is to have a strong Fed that is willing to lend freely, and you throw money into a crisis. That is the point of banking. That's how it works. And to say that, oh, we're never going to do this again, it just was not true.
Yes.
And if we know we're going to do it again, or you can not do it, like the Great Depression, right?
Yeah.
Let them fail. And maybe they could have done that. There would have been some problems. I think that they were overblown, that if you had let them fail, that things would have been awful. I think things would have been awful for Wall Street. Yeah. I don't know if they would have been awful for Americans.
What would you have said to the Americans who maybe have run businesses big and small, who back in 2008 were saying, well, why wasn't my business bailed out, right? Why did you bail out Goldman Sachs? I mean,
how would you respond
to that? Should we go as far as to bail out businesses, homeowners as well?
No, I think we shouldn't have bailed out. They were right to point that out. This is hypocrisy. This is a double standard. I'm losing my house, but Goldman Sachs is getting paid 100 cents on the dollar. I'm being blamed for over leveraging, buying more house, but they were 20 to 1 over leveraged. So why is the same moral indignation against bailing out average people not being applied to bailing out these massive institutions?
Is the for bailout argument true in this case, that if you don't bail out these banks, more Americans would suffer?
No, I don't know. That's a counter thing. I think a lot of Americans suffered after the financial crisis. 53% of the Black population lost their home. That was foreclosed on. The banks were supposed to do these modifications. They just took the bailout money and barely did modifications. A lot of people on the ground suffered after the financial crisis, and yet the market recovered and the banks recovered. And so we call that a recovery and we're back to health. But this is where you tie it back into the real economy, the way people experience life. And there's massive income inequality that's only grown worse since the financial crisis.
We're going to come back to that income inequality and your book, The Quiet Coup, in just a bit. But finishing off in the banking sector, bottom line, are you concerned about another financial crisis now?
Absolutely. We're on the edge. We've been on the ledge of financial crisis. I would say since SVB, since the crypto, we are at a point where capital search for yield has reached kind of beyond the point of it being profitable. It is now it's turned in on itself. There's so much risk, and capital still needs to make yield, like over 6% year after year. And the risks have mounted sufficiently on those balance sheets that they really are being supported by the Federal Reserve at this point. And I think the Fed's going to keep pushing that button. That they've showed that they're never going to let the thing fail. And there's plenty of money, right? Money can just be printed. So I'm not worried about that. I am worried, though, about that the Fed and the banks misunderstand what the thing is underwriting the system isn't just dollars. Dollars rely on this other thing called trust. And when trust goes, it evaporates quickly. And we saw precursors to it during the financial crisis. And I think there will be systemic risk crisis, and then it'll happen. And then people will have to decide, do
what's
we
the
trust the
catalyst?
system or not?
What's the catalyst for this crisis if it were to happen, you think?
Oh, it could be anything. It
Mhm.
could be one big bank failing. It
Yeah.
could be, like another COVID. It could just, it's hard to predict an earthquake.
Commercial real
I
estate, yeah.
like commercial real estate. Yeah. I mean, we've been so leveraged
But
for so long.
but
And
if backstops are coming, why would it be systemic?
um, but because you have to trust in the backstops.
Okay.
And it's all about institutional trust. We're at a crisis point. My colleague Adam Tooze calls it a poly crisis.
Hmm.
There's all of these institutions that are basically shells of themselves, and nobody trusts, like the federal government anymore from both sides, right? There's a nonpartisan
Sure.
distrust of these institutions, and these institutions rely on nothing more than trust.
Well, is decentralized banking the answer? It's kind of an oxymoron now that I think about it. The crypto
Right.
crowd has been calling for decentralization for quite some time. Um, what do you think about this new emerging sector technology?
All banking, all assets, the recognition of an asset class relies on some law and some regulation. So
Hmm.
crypto, you watched come in and say, we're stateless, we're anti, whatever, we're decentralized. And the second they get enough capital, Sam Bankman-Fried was the biggest donor to the Democratic Party. And the crypto industry is very much trying to get a bank charter. They're trying to get into this subsidy, this nice system of subsidies. And so, and then you see, when the Ethereum thing failed, they had to recreate governance. Essentially, you're like recreating the wheel.
It's funny because we're talking about the crypto industry wants these subsidies, but I actually interviewed Thomas Honig, who was a former vice
Yeah.
chairman of the FDIC. I asked him, would you, if you were still chair of the FDIC, would you backstop crypto banks? Okay. Now, we do know that several of the crypto banks, if you want to call them banks, holding companies, FTX, Celsius, failed, and most people aren't getting their money back because those crypto deposits aren't FDIC insured. If you were still director of the FDIC, would you change that rule? Would you insure crypto banks?
Absolutely not. I think cryptocurrency is um, it is a asset that people just like the stock market. It's an asset that they're engaging in either because they think it's better or they're speculating in it. And I don't think they should have any backstop from the government. It is a private enterprise. I acknowledge, and I have no problem if they want to get in that business, that's theirs. But know that you can lose your money and no one will bail you out. And if I were the FDIC chairman, I would make that explicitly clear in the public domain.
So that's the prevailing attitude from the regulators right now.
And but that was my attitude. And I was the nominee for the Office of the Comptroller of Currency. I did not get it, and nobody got it. Nobody. So I don't know if that was it or not. But that was the debate.
Why not insure FTX or Celsius? I'm just naming things that went bankrupt, right?
Because the banking regulation is this cat and mouse game between, we've got these great public subsidies if you get to be called a bank.
Mm-hmm.
And how are you a bank is if it's all up to the regulator. So if you get into this club, you're basically protected by the big money guns, right? They want to tap into this Fed bailout system just like anybody else, even though their whole thing is anti this system.
Tell us about your book, The Quiet Coup, Neoliberalism and the Looting of America. Those are strong words. What's being looted, Professor?
Yeah. Well, I use the word looting because, and I put it in the introduction because there's this, funny Onion article that I'm still laughing about, that during the looting things, the riots after during Black Lives Matter, the Onion wrote this article saying, like, rioters criticized for looting without forming a private equity first. And that got to the heart of what I was trying to say about private equity, is that private equity and writ large. I mean, I teach business associations, and I was explaining to my students a leveraged buyout, which is of old news, but you come in, you load it up with debt, you bankrupt the company, and you get things. And like, why is this legal? It feels like a looting. Right. But it's not, because it's perfectly legal for a private equity firm to come in, buy up a company and make it go bankrupt just for gains. And we call that the free market. And so looting has this this baggage about like, oh, it's only looting if you break a window and take something. But if you're stealing from the public fisc, using laws and your inside access to creating those laws, it's not called looting, it's called leverage buyouts. And so neoliberalism, the basic ideology that started in the 40s and 50s, but really gained traction in the late 60s in the Nixon administration, was this wide scale, like opening up of the federal government to these corporate interests to basically lobby for their own interests. And we've been in that ideology for 30 years. They called it free market capitalism, but it was the exact opposite. Like, I joke, like, if you put neo in front of a word like neoliberalism, it's the opposite of liberalism, right? So they call it neo-capitalism. It's the opposite of capitalism. It was lobbying. It was more, they said, oh, we're going to reduce government regulation. We're going to deregulate. But what happened, actually, what they did is more law, more regulation. There was like 25 laws passed in the span of the 80s to deregulate Wall Street. And what it created was these massive banks with floors of compliance officers and lawyers. So the thing that increased was lawyers, lobbyists, and laws, not free market capitalism. And what the effect of that has been is that if you pay to play, you can be in the regulatory, DC, New York corridor and get the things that you want. If you're outside of that, if you're a small business, if you're a homeowner, you think that we're in a system of capitalism, but increasingly a lot of people are distrustful of that whole system. And the problem that I start with in the book is that now there's this rise of conspiracy theories where they're like, something's fishy. It must be, Jewish bankers. That's why I started that with the Marjorie Taylor Greene thing, where she said, oh, this is the Rothschilds, so you're going back into these old Nazi tropes to find a villain where really it's just in plain sight. It's just this corrupt system and then you have the left saying, well, if that's capitalism, we're anti-capitalism. And I'm intervening in both sides to say, they called it capitalism. It has no resemblance to capitalism. They abused their reading of Adam Smith. Adam Smith was against this very thing. Adam Smith's Wealth of Nations was very much a treatise to say you cannot put too many laws and barriers on trade. And that is what neoliberalism has done. That's to the left. And we need a free market, but it must be free. Right. And on the other side, it's the right now is pointing to, oh, it's the immigrants taking your jobs. It's, that group and that group and that group. And that also happens when you have a system that everyone feels isn't quite working. People are going to point to a villain and they're going to use their priors, and people don't have time to read about Dodd-Frank and the financial crisis. That's all I do. Right. And I barely understood it.
How do we design a system or even just improve upon our financial system such that everyone's living standards, doesn't matter which income bracket you're in, can become better off over time?
So a couple of assumptions built into the system that I think I want to redo. One is that system, the one you described, would be profitable. When we're all profitable, like when we're all doing well, we're all doing better. When we reduce poverty, when we fund schools for kids, when we put money toward infrastructure rather than, say, war, we all make profits. And I think people understand that at a gut level. And so when their politicians come in and say, we want to give you more free market, they're like, yes. So I think voters are all convinced that, look, let's just increase profitability, increase prosperity, increase innovation and competition. And then what we get under the guise of that, it's the lie that I'm against, right? That's a good system, but we're not in that system. What we have now is this big pool of capital up there that just is searching for yield. It is stateless at this point. It's offshore. It's not being taxed back in, and it's no longer invested in profitable industries. It's finance, basically the tail wagging the dog. Finance feeds itself, and it's rare that it comes back in. And then there's these industries that are these legacy industries, weapons, oil and gas, that are subsidized. They have lobbyists. You've got weapons manufacturers lobbying for war, for profits. And guess what? I am invested in them. I, had to take out my 401k when I was a nominee. And this was a big eye opener for me. Is I've never bought, I'm not a stock picker. I don't have time for that, right? So I push a button that's a diversified account. But when you're nominated, I did 8-month vetting process, and I had to take out every single stock that is my diversified portfolio. And it was like Exxon, Raytheon, Halliburton, JP Morgan Chase, all the stuff that, like, when I'm 65, I don't want to retire into an economy where Exxon and Raytheon are making profits year after year. That's an old, dead ideology in my book. I've been in my book, literally in my book. And so that's the way that I think we miss what's really happening with our money. And so in a way, I became a convert to, like, let me convince investors rather than go at regulators. I was a policy person. I was speaking to Washington. And this book, I've pivoted. Let me speak to investors. And if it's just about money, let me make the case. It's more profitable.
What's wrong with Raytheon and Exxon making profits? What's the bigger problem here?
These are not profitable industries, and they are being subsidized uncompetitive. It's not competitive because they have lobbyists that lobby for their own interests as against the people, right? Exxon, I mean, oil and gas isn't really profitable. It's not the future. You know, we should be in these other industries, and it's really hard for that competition to work. You can't, in Texas, there's a law that they propose that you can't look into the risks of oil and gas as a bank. Okay. I mean, it's just like politically insane and economically just absurd to say that banks are barred from looking at the environmental risks of their portfolio. And the Texas, basically, comptroller or whatever, said that they're going to divest from, Larry Fink, BlackRock, when they started talking about environmental concerns, not as a moral matter, not because they cared more about the environment, because of the bottom line. So that's when you're like, this is not about profits. It's about access.
There's a growing wealth gap that people, even watching my show, are concerned about. Income, wealth gap, however you want to define it. I'm looking at wealth in particular right now. This is the chart from the Federal Reserve. And I'll show a chart for the screen for the audience later, but I'll just read you the latest numbers here. The bottom 50% collectively own $3.6 trillion of wealth in the U.S. 50 to 90% is 45 trillion. Now, here's where it gets interesting. The 99 to 99.9% own 24.6 trillion. The top 0.1% own nearly 20 trillion. So in other words, the top 1% owns almost just as much as the 50 to 90%, right? This is not new. This has been the case since forever, but it's widened ever since now.
Not forever. It's widened. It's widened phenomenally. Between 1934 and 1970, the highest income was less than $1 million. The difference between GM, Jim Roche was the president. His income was like 6 times the average worker, and now it's like thousands of times more.
Sure.
And this is exactly a result of neoliberalism. And it is created a hungry capital machine. So if you look at the money, if you can look at it systemically, that 1% has so much money, and that money needs to grow. Capital requires yields, either at minimum 6%, but hopefully more, right? If you're a private equity investor,
right?
And where is it getting the yield? It's sucking the lifeblood out of the economy. Private equity firms own most of the single family homes in this country because that's a good interest, like solid interest payment. And then that leaves these communities without homeowners. So you have increased homelessness, you have blight spreading across the country. That's not profitable. It's not profitable. It may be profitable in the short run to do a leveraged buyout on Toys R Us and fire all the employees and get your gains. In the long run, it's not profitable. And what are profits, right? Profits are supposedly about continual sort of increase and innovation and creation. And we're not creating. We're sucking on the fumes of what had been created into this financial sphere. It's all finance. It's like that finance has just ballooned. It's like a cancer on the real economy, and it's gotten worse.
One could argue this is just a result of capitalism at work, right? The rich are getting richer, but a lot of people are using this as an example of America, the poster child, the land of opportunity. You work hard, you make a lot of money, you become the 1%. Anybody can make it there.
Yeah, I mean that first of all, just like data-wise isn't true. And it's not, I don't know what capitalism is in people's minds. If we're talking about a system whereby money and markets are a creation of law. So when a bank comes and says, regulator change my law so that I can do this derivatives thing, and they're making billions, trillions of dollars because a regulator changed that. Is that capitalism or some other thing, right? So I think this debate, those false binaries, is exactly what neoliberalism succeeded in doing, is to say, this is about capitalism versus socialism. First of all, Stalin was as socialist as we were capitalist. Stalin was a tyrant. He was murdering people in gulags, right? It was war and destruction. And our economy was not capitalist going into World War II. We had a massive state-run industrial sector that was very heavily protected in the pre-Bretton Woods system. We had all of the 99% of the mortgages were federally insured and federally funded. In no way was the US system capitalist in 1950. It was a great system. It was incredibly profitable and mutually beneficial, but it wasn't capitalist.
I'm just looking at this wealth gap chart again, and it looks to me like the top 1%, well, even the top 50 to 90%, they just own assets, right? So if you correlate the wealth to the stock market, there's a good correlation there. It's not really, is it really just as simple as that the wealthy own assets, and so it's just tied to the overall state of the economy and markets overall?
Yeah, and the asset ownership only grows in one direction, right? This was Piketty's famous R is greater than G. R grows and it accelerating grows, right? Yeah. Capital grows at a phenomenally fast rate. And especially when it's abstract. So it's one thing to own a house as an asset, but we now have assets in derivatives. We have assets that are increasingly abstract from anything in the real economy, and those can grow very fast.
So
especially when they're not being taxed.
What is the end result of this widening wealth gap?
I've described it as a cancer. It's a metastasizing zeros and ones on balance sheets over here. And where is that yield coming from? It's from an increasingly usurious state. You've got student debt. You've got a whole generation that won't be able to afford a house. And increasingly, just jobs we're talking about, maybe we'll finance students into their future such that you'd have to pay back your student loans by your job forever, right? So it's debt. That capital's other side is debt. And as capital grows and conglomerates into one stagnant pool, debt has spread far and wide. So we are headed toward, this is what Keynes said, is usury will make slaves or masters of us all, but increasingly, like, the masters is a very, very smaller and smaller and smaller. And I don't like this, these are just Keynes's words, but essentially that's what debt does. Right. Usury compounds very, very quickly. Yeah. And we're at late usury. And this was 1978 was the first time we basically deregulated usury in all of human history.
Well,
that's very recent.
One argument is that if everyone at all income levels are becoming better off, then it doesn't really matter if the wealth gap is widening, as long as everybody is becoming better off.
Yeah, I mean, if we have a productive society where there's rich, no one's advocating just everyone makes the same. That's absurd. Not everyone wants the same, but the drop can't be that high. If and you can see this in the middle class. If you know that if your kid doesn't get into college, he's gonna drop into this maybe abyss of homelessness and drugs and whatnot. That pressure on the top or the middle class gets higher because there's this other like top 20%, right? That's gonna get squeezed out one way or another. We're not all going to be 1%. That's how percentages work, right?
I'm not saying this is good or bad, but this is my next point. CEOs in America make a lot more than other CEOs in other countries in the same peer group. And in fact, I'm reading this article from the BBC. CEO pay in the US has grown 1,300% since 1978, according to the Economic Policy Institute. And like I said, they out-earned their peers in other countries. How did this happen?
Yeah, that's neoliberalism. Neoliberalism said, one, that the corporation is about the shareholder supremacy, meaning not just what shareholders want, but that shareholders all want just returns on capital, and that the CEO that is able to give that to them should be rewarded by the market, and that the market accurately prices in all information. So you have US Steel CEO David Roderick saying, we are no longer in the business of making steel, we are in the business of making profits. So you bring in these CEOs that are able to change their companies or incentivized with lots and lots of dollars to change their companies from production into finance. So it's just the financialization of the entire economy, and the gains go to the CEO. Why do you have a leveraged buyout? Because there's a huge payout for all of the managers involved, and the employees and the products and the supply of anything that the company actually does suffers, but there's payouts at the top. And the ideology that enabled that said essentially that that's a free market. You should be able to earn anything, and that's capitalism, right? And so caps were lifted, and also taxes were lifted. The 2 and 20 private equity firms, you pay 2% on capital gains. It's just law.
Is there research to suggest that CEOs in America are overpaid in the sense that they don't add as much value as they're paid? So, because certainly if that were the case, their shareholders would vote to not pay their leadership that much, right?
Well, it's about what is value. If value is, again, shareholder, gains, then you could make an argument that it's worth it because they're increasing shareholder gains. But where are they getting it from? What are we not measuring when we measure these metrics? And so a lot of this is really about metrics. It's about what we measure when we look at the economy. And you talked about the asset class, but the stock market itself, we measure economic health by the stock market, but only 30% of Americans are invested in the stock market, 30 to 40%. And then even that percentage, most of us, it's through 401ks. It's hardly, so we're not measuring, other things that arguably are way more important, right? Homelessness. Why isn't that a metric?
Well, yeah, well, exactly. I mean, is there any other measure to a company's success besides the bottom line? This is something that we had to study in school and we never figured out an answer. I went to business school and that was one of the classes we had to take. But anyway,
this is Milton Friedman. The opening shot of neoliberalism, some might say, it was 1970. GM had, the activists had come to GM to demand that they change from the combustion engine into a more environmental friendly one, and also to diversify, blah, blah, blah. Flint, by the way, this crisis was just downstream from GM. And they saw that coming. This is 1970. And Jim Roche kind of maybe bent to this. And I tell the story in one of the chapters of the book. And Milton Friedman and the neoliberal economists basically say that the only business of business is to increase profits year after year for shareholders. And that's the only thing that should be measured. And it's not, okay, yes, it was an op-ed, but then that got reified in law. So you have the Delaware Chancery Court. A lot of activist shareholders now take corporations to task saying, we shareholders have voted that we would like you to not do this thing. And the Delaware courts will come back and say, no, shareholder supremacy. So it became part of the law. It became an evaluative metric. Same with, I talked about law and economics efficiency. So cost benefit analysis of any environmental law has to be done before it can be passed, meaning are the costs on business more than the benefits on business? So all you can measure is what can be calculated in that algorithm. It's not, what about the rivers? What about 10 years in, right? And that those things actually do have dollars and cents. It's just longer sighted than the Q1, Q2. So that's kind of all of this is a result of neoliberalism, not just the ideology, but neoliberalism as embedded into law.
Interesting. Tell us about other areas of research that you're currently working on now.
I'm actually taking a step even broader and looking at the gold standard from as the way that gold shaped and narrowed our views of what money is. That gold is scarce, money is not. Money is just a language. Money is a measurement. It's just a made up way of keeping track of things. And yet we have this idea of scarcity built into the monetary system. And I follow the gold standard through the British Empire, and it's all kind of baked into colonization, and it's baked into the way that some countries needed supremacy over others, and then they got to impose their measurements. The British, I'm talking about some countries. It's really you need a longer scale look at these things when you're looking at money. Money is the most fascinating thing to study, I'll say.
Is gold money by your definition?
Money is what we accept as money.
Right.
And what people accept as money. And for many years, gold was money, but there's no reason for gold to be money besides some ancient emperor made gold into coins. But the coin itself, it wasn't the gold. It was the fact that the Roman emperor or whatever would accept that for taxes. Okay. And so money is what the government will accept as taxes. And so insofar as you're ruled by a nation state, if you're not ruled by a nation state, it's whatever community will accept as the transaction, right? So money has been all sorts of different things across time. Right now, money's not gold. Right now, money is assets, zeros and ones that have some denominator on them that the Federal Reserve recognizes as money.
We'll end here. Would a return to the gold standard today fix a lot of the problems that our economy faces?
The gold standard, the gold standard was led to World War I and World War II and the Great Depression. Keynes is
it led to World War I. How did it lead to World War I?
It created artificial resource constraints between the governments there, and gold it was scarce. It was always being extended. The US had depression after recession after recession after recession, panic after panic after panic because of gold. You can't extend gold, and money wants to be flexible. And so gold favored a few elite interests. Gold has the same history as all of this stuff. It was a corrupt system that made gold the denominator, and it imposed artificial scarcity. And we went off gold. The countries of the world went off gold effectively during World War I and World War II, and during the Great Depression. But the figment, the imaginary idea of gold stuck around for way too long.
I was using gold as an example here, but a return to any sort of standard whereby you back the currency to a hard asset, a commodity, or even in today's world, a digital asset, that wouldn't be the ideal system for you?
No, because money doesn't need to be scarce. Money can be abundant. Like you said, we can have as many homes and thriving businesses as our economy can support. There are constraints. There are resource constraints. We don't have it. Not everyone wants to be working all the time, and we don't have enough resources to make things. So we need a standard of money that measures right. It's just a measurement.
Well, the other constraint is inflation, right? You have too much money, you get runaway inflation.
Well, if you have too much artificial money, if you have money that is just a measurement, that is just because there's two things that money does. One is as a hoard toward the future. That's what gold promised, but that's a false promise. The other is as a currency, right? And this is what crypto and some of the Ethereum tried to do as a payment system. I want to get your thing, and we just need a common language to say, what's your thing worth compared to my thing? What is my time worth? That's one role of money. The other is this hoarding. And this is the problem with the usurious system. There's a reason why anti-usury is in all the holy books, is because it screws up your economy. It only grows in one direction.
Sure.
And we're at that late stage of there's nowhere else for it to gain yield. There's nothing else to suck out.
Well, very interesting, Professor Baradaran. Where can we learn from you? Where can we follow your work?
Well, all the regular Twitters and stuff. This is the new book, The Quiet Coup. So you can just get that anywhere. And yeah,
perfect. We'll put the link in the description down below.
Thank you.
So make sure to follow Mehrsa there. Thank you very much for speaking again soon.
Thank you, David.
Thank you for watching. Don't forget to like and subscribe.